Now, between May and November 2020, CCAF, in partnership with the World Bank and World Economic Forum, conducted two far-reaching assessments, building an unprecedented understanding of how fintech regulators across the world have responded to the COVID-19 pandemic, as well as how the fintech industry itself has adapted to the pandemic and the resultant regulatory changes. This session will be offering each and every single one of you an understanding of the real-time impact that COVID-19 is having on both the fintech industry and the regulation of fintech. We are delighted to have with us Mahesh Uttamchandani, World Bank Group USA, as well as Philip Rowan, Cambridge Centre for Alternative Finance, University of Cambridge, Judge Business School, United Kingdom, and Tanya Zieglerten, Cambridge Centre for Alternative Finance, Judge Business School, University of Cambridge, United Kingdom. Let's welcome them.
Thank you very much, and welcome everyone to this session on how COVID-19 is changing digital finance and regulation. My name is Mahesh Uttamchandani from the World Bank. And there's no question for all of us that work in areas of finance, financial inclusion, and access to finance, that fintech is increasingly recognized as a key enabler for financial sectors worldwide, enabling more efficient and competitive financial markets while expanding access to finance for traditionally underserved consumers. As we noted at the World Bank in our joint launch of the Bali FinTech Agenda in October 2018 with the International Monetary Fund, fintech can support economic growth and poverty reduction by strengthening financial development, inclusion, and efficiency. And the critical challenge for policymakers is to harness the benefits and opportunities of fintech while managing its inherent risks. There's also no question that the COVID-19 pandemic has further accelerated the widespread transition of consumers to digital financial services and highlighted the significant benefits of DFS, while also demonstrating how risks to consumers can increase in times of crisis and economic stress. Authorities responsible for example, financial consumer protection, are increasingly faced with the challenge of identifying new or heightened risks to consumers generated by fintech and developing effective risk mitigants. With that in mind, we're going to learn today about great research work that has been taken on jointly by the Cambridge Judge Business School through the Cambridge Centre for Alternative Finance with support of the World Bank Group and the World Economic Forum. And I'm about to introduce you to our two fantastic speakers, Philip Rowan and Tanya Zieglerten. But before I do that, I want to remind all of you to post questions for Philip and Tanya in the chat box throughout this event, and we'll select some of these questions for the Q&A session later. I also want to thank the 118 central banks and other regulatory authorities from 114 jurisdictions who participated in the regulatory study that you'll hear about shortly, and also the 1,385 fintechs from 169 jurisdictions who participated in the market study, and the 110 plus network partners who supported its dissemination. And of course, you'll also be hearing about that market study. I also want to thank the World Economic Forum for being such a great and valuable partner on the market study. And I know our colleagues at the Cambridge Centre are particularly thankful for the foundational funding provided by the UK Foreign and Commonwealth and Development Office through the Prosperity Fund Global Finance Programme and the Cambridge Alternative Finance Collaboration Network, which supported this research. So let's turn it over to our great speakers. Let me introduce Tanya Zieglerten. Tanya is the lead of global benchmarking and a senior research associate at the Cambridge Centre for Alternative Finance at the Cambridge Judge Business School. And in this capacity, she leads the center's market-based research, tracking the growth and development of capital-raising alternative finance activities spanning several regions of the world. And she was the lead author in the COVID-19 FinTech Market Rapid Assessment Study. And I'd also like to introduce Philip Rowan, who leads the Cambridge Center's initiatives on regulatory innovation, regulatory responses to financial innovation, and works with financial regulators, central banks, governments, and other development partners in their efforts to create informed regulatory environments for financial innovation. He has a particular focus on developing and emerging markets and is a leading authority on regulatory sandboxes and innovation offices. With that said, Tanya, let me turn it over to you to take us through some of your findings.
Thank you so much. And thank you so much for allowing us to be here to present the findings of this report that we just published within the last few weeks. This study sought to understand how financial technology firms have performed in the context of COVID-19, how they've responded as an organization, shifting their products and operations to address challenges and take advantage of opportunities, and also to identify the issues that these types of firms are facing on a regulatory front. As you can see by this map, this study allows us to understand how the industry has reacted, adapted, and endured since the start of the pandemic. And the study is based upon firm-level responses from nearly 1,400 fintechs from 169 countries and jurisdictions. What was interesting to see was that 43% of all of the surveyed firms are actually operating in more than one country. And on average, when they are operating in more than one country, you see operations in at least 4 or 5 countries. If we go to the next slide, this study covers 13 primary verticals, and as you can see, we received the greatest number of responses from the digital lending vertical, followed by digital payments, and then digital capital raising. These three made up just over 50% of our entire sample. And though each vertical sees ample representation from each jurisdiction, around 30% of digital lending firms were headquartered in the Asia Pacific, around 21% of payment firms were in sub-Saharan Africa. You do see some concentrations of verticals and regions, though on balance, we actually had a fairly good coverage of firms by headquarter and also firms by vertical type. We also grouped these fintechs. Sorry, can you go back to the previous slide? I'll tell you when to switch. We also grouped these fintech verticals. Thank you. We also grouped these fintech verticals into two overarching themes, with about 80% of our firms surveyed as retail facing and the remaining 20% as market provisioning. So in this context, what we're doing is defining retail facing as firms that are servicing households, consumers, and MSMEs. And that would encapsulate digital payments, digital lending, digital capital raising. And then on the market provisioning side, these are firms that are supporting back-end infrastructure or other key functionalities of fintech. And those would be, the enterprise technology provisioning, digital identity, data analytics. Now we can go to the next slide. An important indicator of market performance is that of transaction volumes. And here we are comparing changes in transaction volumes in the first half of 2020 compared to the same period in the previous year. Overall, the global fintech market is growing, with 12 out of the 13 verticals reporting year-on-year growth. However, so what we see is, for example, digital payments, which is our second largest cohort of a vertical, reporting a 21% increase in transaction volume in that first part of the year. And we saw this in particular in MENA and in sub-Saharan Africa. However, you do see the outlier in this chart, which is that, of course, of digital lending. And here what we saw is that globally, digital lending firms did report an overall decrease in transaction volumes. It's worth noting, however, that the performances are quite dependent upon jurisdiction. The most drastic drops were reported in Asia Pacific, while firms that were in MENA actually reported an increase in their overall transaction activities. So this is to say that although you might have some overarching themes, you definitely will see specific divergences depending upon the vertical and its jurisdiction. If we go to the next slide. We also looked at fintech performance by COVID-19 lockdown stringency. To determine this, we leveraged the Oxford COVID-19 Government Response Tracker, which rates countries on lockdown measures, taking into account factors like restriction on mobility and school closing. We assigned each of our respondents with a corresponding rating from Oxford, and then we created 3 equal quantiles based on this. This is allowing us to create a proxy for policy on the severity of lockdown. So what we then see is that the largest increase in transaction by both volume and by number came from firms that were in markets with the greatest lockdown stringency. On balance, the higher the COVID-19 stringency, the higher the adoption of financial technology services. This increased adoption is not necessarily caused by the pandemic, but there is certainly a correlation between stricter lockdowns and an increased adoption of financial technology services. And this was a trend that was consistent across all observed verticals where firms in high stringency jurisdictions did in fact report much faster growth rates across most of the key market indicators. If we go to the next slide, we then decided to separate against advanced economies and emerging markets and developing economies to see if there were differences in the performance and in some of these key performance metrics, such as transaction volumes, but as well, we also wanted to understand the differences in new customers and that retention of customers. What you see is that overall, firms that are coming from emerging markets or developing countries do outperform those that were in advanced economies on that year-on-year analysis, although not at huge degrees. Nevertheless, it is important to be able to see where some of these differences emerge. If we go to the next slide. The fintechs that responded to this study were fairly responsive when it came to implementing changes to their existing products, services, and policies. Just over 2/3 of the firms did in fact report at least making 2 or more changes to their core offering in response to the pandemic, and a further 30% were actually in the process of implementing changes to those existing products and services. The retail-facing fintechs, and in particular the digital payments, digital lending, and digital banking, were among the most nimble verticals when it came to implementing changes to their offering. In this case, with more than 78% of those firms making at least 2 or more changes. When we observe the entire data set, we see that some 30% of firms are actively making amendments to their qualification or onboarding criteria. And in fact, this is actually more than half for all digital lending platforms that actually did implement this change. After qualification criteria, the changes that firms tended to make the most were those that positioned their pricing, and this was among the top tweaks that we see. You see changes in fee or commission reductions, payment easements, fee or commission waivers. These were adjusted by at least a quarter of all of the participating firms in this study. If we go to the next slide, we're then going to see not just how firms, changed their existing criteria or changed their existing products and services, but now we're looking at how they've launched new things as well. And what we wanted to understand was the variety of new products, of new services, and of new features that firms were implementing. And we found that around 60% of the panel had introduced a new product or service, as well as changed. Interestingly, the thing that was the factor that was the most was that of value-added non-financial services. This was among the highest new category, especially for firms that are categorized as retail-facing. And in this case, we're seeing firms introducing a variety of, in particular, information-based services with an emphasis on financial education and literacy. This also was particularly noted by those digital lending platforms, where they are placing the greatest emphasis on this new product category when compared to the other verticals. And we have an interesting example of one of these. There's a digital lending platform in India that recently created an add-on portal that helps low-income female entrepreneurs understand the financial products that their platform is offering. These are the kind of value-added non-financial services that we saw ample and plentiful examples of. It's also interesting to note that enhanced cybersecurity is ranking as the second most updated feature or new feature. So what you see in this chart is that just shy of 30% of all of the fintechs had already enhanced their cybersecurity features, and a further 12% were in the process of doing so. And in particular, again, retail-facing fintechs like digital payments and digital banks were amongst the highest to already adopt this feature at around 40% in those cases. And on the market provisioning side, we actually saw that almost half of all of the digital identity firms had implemented this feature, and a further 40% were in the process of doing so. So while it is encouraging to see so many firms placing a focus on cybersecurity, it does beg the question, has enough been done? The CCAF and the World Bank recently published a regulatory-focused companion study, which Philip is going to be talking about, and he'll be noting some of the things that they found in their study around cybersecurity as well. If we go to the next slide, fintechs also require assistance from their primary regulatory or supervisory relationship. And so we wanted to understand the key regulatory support mechanisms that firms need in order to weather the storm. It's worth noting that many of the measures listed here are not fintech exclusive, but are more generally applicable to financial services. So when we look at the fintech response in aggregate, what we see is that core regulatory activities related to their customer or client onboarding processes were paramount, with firms reporting already using interventions related to eKYC, simplified customer due diligence, supporting of remote onboarding at the highest levels. That said, on balance, most fintech verticals are not yet recipients of regulatory support. What we did see, though, is there is one caveat, and that is around digital payments. That vertical did actually have a higher uptake of utilizing or already benefiting from regulatory support. Urgent need, however, is ultimately what the fintechs really indicated in this study. Urgent need for regulatory support was far more pronounced. Overall, most firms reported urgently needing faster authorization for new activities, and this is then followed by streamlined products or service approvals, and then those that are, again, facing all of those client onboarding sides, so the simplified customer due diligence, so on and so forth. Interestingly, firms that are in emerging markets did tend to already utilize regulatory interventions more than those in advanced economies. However, we also saw that they were the ones that were reporting urgently needing support to much higher degrees. The study found that nearly half of the firms that were in an emerging market urgently needed regulatory support, and there was a particular emphasis on faster authorization, with just shy of 50% of the panel indicating so, and streamlined approvals at 40%. And then finally, lockdown stringency is another useful way to measure regulatory usage and need. For firms located in high stringency markets, around 21% had reported already benefiting from regulatory support, but a further 45% urgently needed assistance. So what this is saying to me is that this suggests that regulators were more likely to extend support measures in countries where lockdown measures are more severe or in emerging markets, but also that this is where there is the greatest need for assistance, and that is what the firms are telling us. If we go to the next slide. Thank you. The study wanted to shed light on how fintechs are also utilizing or might need to utilize some of the regulatory innovations like sandboxes, innovation offices, or hackathons or tech sprints. And when we consider the overarching environment, on balance, fintechs overall have been less reliant on the innovation mechanisms when we compare this to the aforementioned core regulatory or supervisory interventions. Yet the caveat is that for firms that are in that market provisioning facing activities, in particular those that are in RegTech or that are in enterprise technology, these are amongst the highest to use or urgently need to use regulatory innovations such as the ones on the screen here. What we do see is that there's a greater divergence on the use or need when we consider these innovations in terms of their income level grouping. Firms located in emerging markets tend not to utilize such innovations. Firms located in emerging markets tend not only to utilize such innovations more than their advanced economy counterparts, but they also urgently need access to these innovations, sometimes outstripping this by double. So this might relate to the fact that the fintech ecosystems are still in flux in many emerging markets or have yet to be established bespoke fintech regulation or clear parameters. And that kind of then lends itself to understanding why they might need some of these innovation mechanisms more so than in their advanced counterparts. And if we finally go to my last slide, thank you. As fintech firms deal with the day-to-day operational challenges, we wanted to understand, how firms were dealing with the factors that impacted their platform in terms of operability, the costs, and certainly the associated operational risks. In aggregate, fintech firms do note slight increases in their platform downtime, in their agent partner downtime, certainly in the number of unsuccessful transactions, and this is amidst increased costs relating to onboarding, increased costs relating to data storage. But a really clear divergence appears when we look at these operational challenges against lockdown stringency. Fintechs operating in countries with high stringency measures reported the greatest operational challenges and incurred the highest costs. Fintechs in high stringency markets reported markedly higher instances of platform downtime and agent partner downtime when compared to those in lower medium. Similarly, costs are much higher for those high stringency markets, particularly as we relate this to onboarding costs. If we consider cybersecurity risk all on its own, what we then see is that firms in high stringency markets particularly noted an increase in their perception towards cybersecurity risk. And this is actually more than double those in those low lockdown markets. Firms located in emerging markets also reported high perceptions of cybersecurity risk. In this case, they were reporting around 19%. When we look at the second half of this graph, fintech, or the second half of this slide, fintechs globally also reported a downward revision of their fiscal year 2020 turnover targets. And interestingly, firms in high stringency markets reported kind of almost unchanged revenue targets. However, those that were in low stringency markets reported an 8% drop. It's also interesting to note that the firms that were in advanced economies also revised their targets down by around 7%. Whereas those that were in emerging markets really only registered around a 1% drop. This might suggest to us that the firms that are in high stringency jurisdictions or emerging markets are able to capitalize on some of the market opportunities that have been presented to them with respect to COVID-19. But it would be remiss of me not to mention that fintech's perception towards their capital reserves, their fundraising outlook, when we talk about financial positioning, we do need to talk about some of these things as well. And so despite aggregate increases in transaction volume, we see, overall, we have to look at that against the fact that we are seeing increases in headcounts, rising operational costs that are likely going to impact firm profitability. And so on balance, this study found that more than 50% of the fintechs indicated that the pandemic had caused negative impact on their capital reserves. 40% of the surveyed firms also indicated that their current valuation had been negatively impacted, and over a third of firms also noted negative impacts when they were considering their future fundraising outlook. And so on this note, I'd like to hand over the baton to my colleague, Philip. Philip is going to lead you now through the regulatory assessment. So over to you, Philip.
Thank you very much, Tanya, and good morning, good afternoon, good evening to you all. It's my pleasure to share with you the findings of the companion regulatory study, and we're going to look at the impact that COVID-19 has been having on the regulation of fintech and regulatory innovation initiatives. Please do keep the Q&A coming in for Mahesh on the chat, and we'll have some time for discussion on that following the presentations. So this study represents one of the largest empirical studies to date on the impact of COVID-19 on the regulation and supervision of fintech. And this was conducted between June and August of this year, 2020. And as Mahesh shared, we're very grateful to the 118 central banks and other regulatory authorities who participated in the study. So around 43% of respondents were from central banks, with the rest made up of other supervisory and regulatory authorities from around the world. So we begin with an insight on how COVID-19 has affected the provision of fintech, the prioritization of fintech within regulators. And here, as you can see from the figure, the increased digitalization of financial services that Tanya referred to in the study looking at the market side has meant that fintech has really moved up the agenda or remained a high priority for regulators around the world. The contrast is perhaps that in emerging markets and developing economies, fintech has really moved up the agenda, while for advanced economies, it has remained high. And at the regional level, we see that, for example, in sub-Saharan Africa, around 70% of regulators stated that fintech has increased in priority. And perhaps even more striking is that not a single regulator that responded to the study in the Asia Pacific region stated that fintech had decreased in priority. So this then looks at the observed impact of COVID-19 on fintech activity according to the regulators. So this is the regulators' perception of the impact of the pandemic on fintech usage and offering. So regulators shared that they have observed strong increases in the usage and offering of many fintech products and services since the outbreak of the pandemic, and this is broadly reflective of the actual fintech transaction volumes that Tanya shared a little bit earlier. And perhaps unsurprisingly, in a world where there are physical barriers to using cash and engaging in physical transactions, the digital payment and remittances sector has observed the largest increase, and this was really reinforced by regulators in jurisdictions with more stringent COVID-19 containment and closure measures, reporting larger increases in the digital payments and remittances sectors. However, concerns about the impact of COVID-19 on traditional, shall we say, regulatory objectives of consumer protection and market integrity are reflected in the increasing risks which regulators perceive with respect to COVID-19 and fintech. And the most important perceived risks were around cybersecurity, operational risks, and consumer protection risks. So again, that theme of cybersecurity that Tanya mentioned earlier, really emerging among the regulators that responded to the survey as well. Particularly in advanced economies, regulators regarded cybersecurity as even more prominent a risk in comparison to emerging market and developing economies, with 90% of them stating cybersecurity as a top 3 increasing fintech risk. And while COVID-19 might have magnified regulatory attention on certain risks, many regulators did also emphasize that cybersecurity and fraud risks are not inherently novel or unique to issues related to COVID-19, as you can see in the quote on screen. Turning to some of the measures taken by regulators which affect digital financial services and fintech providers, many of these are more general measures taken in the wider financial services sector, which might also impact the regulation and supervision of fintech activities. And you'll note here regulators enacting measures to support digital financial inclusion, particularly around KYC, eKYC, AML, and digital identity initiatives. And one public example of this comes from Egypt, where the central bank has launched an eKYC solution to facilitate the electronic opening of bank accounts, while simultaneously increasing transaction limits for mobile financial services. Also notable here is this recurring theme of cybersecurity, with 29% of respondents undertaking measures in this domain. So one of the ambitions for this study was also to look at the fintech specific measures taken, and you can see that 37% of regulators who responded have undertaken at least one measure targeting one or more specific fintech sectors. The digital payments and remittances sector is the most commonly targeted, again, reflective of the particularly high reported increase in usage and offering in this sector, and regulators prioritizing digital payments and remittances during the period of the pandemic. The Central Bank of Kenya is a good public example here, having increased the transaction and balance limits for mobile money by over 100% in March at the start. and reporting subsequently that this has led to increased levels of mobile money usage in the country. And there's a table in the full report which gives further examples of fintech-specific measures undertaken by regulators in response to the pandemic. So another key objective of this study was to understand the challenges that regulators are facing in developing their regulatory response to fintech in light of COVID-19, which are, as they shared with us, considerable. And the most frequently identified challenge was that of performing core functions while working remotely, identified by almost 1 in 2 respondents, as you can see in the graphic. And not only does this present challenges for carrying out activities that are normally undertaken in person, such as supervisory site visits, there are equally technological challenges with regard to the remote access to IT infrastructure and access to accurate and timely data, which help regulators do their job. Coordination with other agencies domestically, always a theme even outside of a period of crisis, has also been a key challenge for regulators during COVID-19. This might be particularly pronounced in the case of fintech activities, which, as many of you know, may cut across multiple regulatory jurisdictions and multiple regulatory authorities. So one of the things we also looked at was, given the regulatory measures that are being put in place, the challenges that regulators are facing, what specific types of assistance that regulators would most benefit from in order to support their work on fintech and digital financial services in light of COVID-19. And at the aggregate level, you can see that the most important type of assistance regulators state that they would benefit from is skills development, with around 80% of respondents stating this is the most important. Secondly, technical support was a key theme cited by around 2/3 of respondents. And here, regulatory innovation initiatives such as RegTech and SupTech initiatives were a particular theme, with respondents requesting support to develop things like roadmaps and strategies, but also specific RegTech tools. And around 1 in 4 respondents are looking for content expertise on topics such as the development of regulatory frameworks for fintech, how to conceptualize and develop regulatory innovation initiatives, and other fintech domain-specific knowledge. So turning briefly to the impact of COVID-19 on regulatory innovation initiatives and regulatory responses to fintech, such as innovation offices and sandboxes. Again, it seems that the pandemic has played largely an enabling or catalyzing role with respect to these. Indeed, not a single regulator among the 118 who participated shared that or reported that the cancellation of a regulatory innovation initiative due to COVID-19. Though, as you can see, around 20% did report that they had experienced a delay. In sub-Saharan Africa, around 1/3 of innovation offices have been delayed and fewer sandboxes have been accelerated. In the Middle East and North Africa region, we see a really big focus on digital infrastructure initiatives such as digital identity initiatives, eKYC, and so on. And RegTech and SupTech was a key theme, with 70% of these initiatives accelerated in light of COVID-19. So moving on to my last slide, we knew that prior to the pandemic, some of these regulatory innovation initiatives have been a key area of focus for regulators. The challenge identified for these initiatives by regulators in response to COVID-19 has really been around some of the speed of delivery. As you can see, central banks in particular expressing this challenge around being able to move quickly in their regulatory innovation initiatives and get companies onboarded or providing them with support. coordination with other agencies, again a key theme here, as well as dealing with the increased demand upon the services that that COVID has brought about. So let me bring in my colleague Tanya again, just to reflect upon some of the common ground and diverging views that we found in the two studies. So Tanya, I think in the regulatory study, we saw that regulatory support has been really focused particularly at high lockdown jurisdictions and in emerging markets and developing economies, and 65% of regulators undertaking a measure targeting digital payments and remittances. Would you say that's kind of broadly reflective of what you find the fintech market ecosystem themselves have been sharing?
Yeah, absolutely. I mean, the digital payment, I hear a bit of an echo. The digital payment vertical in particular were among the most reactive and the ones that were utilizing regulatory mechanisms more than any other vertical. One of the things though that I also found really interesting in your presentation is that you're noting that around 15% of the regulators have also focused on digital lending, or 17% have also focused on savings and banking, and that is pretty reflective of what we're seeing, that it is kind of around that range of firms that are able to take advantage. But I think a big part of it though is that there's still a lot of platforms and still a lot of fintechs that have yet to be able to to take advantage and urgently need some of this help, but where the emphasis is being placed tracks very well with the emphasis that these firms need as well. I mean, and it's kind of funny because it really shows us where the emphasis is. So I mean, for us on our study, we really saw that there was an emphasis on that client-facing regulatory support innovations or mechanisms. We really see an importance on eKYC, that remote onboarding, that simplified customer due diligence. And I think that this was a trend that we saw also from your study, Philip.
Yeah, definitely a big focus among the regulatory community in really making the digital payments and remittances sector able to function at this time when physical cash transactions were made more difficult, and moving at a quick speed. Regulators perhaps, and I can say this, I think as a former regulator, not renowned for moving quickly, but I think that this time of crisis has really forced fintech and digital financial services up the agenda, and it's pleasing to see the speed with which regulators have been able to react. Maybe just kind of moving on in the interest of time, we did, however, find some I think key differences in our studies with respect to some of the initiatives which regulators have been prioritizing. So I shared a bit about the acceleration and the introduction of new regulatory innovation initiatives like innovation offices and sandboxes. But I think you heard a little bit different from the fintech market ecosystem in terms of what is most useful for them at this period.
Yeah, I think that's the biggest thing, is that we really are seeing that, yes, of course, there are fintechs, in particular the market provisioning fintechs, that are, looking for and urgently need support in those innovation initiatives, and in particular, those innovation offices. But broadly, what firms really are seeking is that help on that core regulatory activity. And it's not surprising then to me to sort of see from your presentation that around 49% of your regulators that were surveyed actually did indicate that they are having difficulty performing those core regulatory activities. That very much tracks with, with where their difficulties lie, is also very much where the market, realistically is seeking that help. And I think for me, what's been really interesting is also seeing, even when we just think about those innovation initiatives, for us, the thing that was needed and utilized at higher degrees was really around those innovation offices. That's where the firms from our market study were spending more of their focus with respect to innovation initiatives. Whereas, I got the impression, that there's a significant emphasis on the sandboxes and developing sandboxes on the regulator side. Is that a fair assessment?
Yeah, I think that's right. Especially in particular regions, I think that the sandbox has certainly captured the imagination. We see, I think, from CCAF and the World Bank's research, more than 75 of these either in development or in place around the world. But as you reflected, they do take some time to develop and onboard firms at a time when there's a real emphasis in getting new products and services out to market. So there's some interesting challenges, I think, for regulators and the fintech ecosystem alike. And clearly, the more engagement and collaboration between the two, then hopefully the mutual benefits that will follow. But let's bring in Mahesh again as we move to the Q&A section. So Mahesh, if there are any particularly pertinent questions that you've seen from the audience that Tanya and I can get our teeth into, it'd be great to hear them. Thank you.
Well, first of all, thank you both for such great presentations. And I have to say, as someone who works with regulators in every region of the world on a range of these issues, I found the data in the reports incredibly helpful. And I think regulators certainly will find it useful to see what else is happening in other parts of the world. Tanya, in some ways, the report confirms a number of, I think, our reasonable suppositions, but there were some surprises in there. What was most surprising to you coming out of your work here?
Oh, man. I think for me, one of the things that was surprising actually was, thinking about where the regulatory needs were. I don't think I was that surprised initially with that, with eKYC, customer due diligence on onboarding. But what I was a little surprised about was just some of the degrees to which the firms were just, in some respects, quite desperate for help on, streamlined approvals, on authorizations, because it matches very well with what we're seeing with respect to the launching of new products and services. You have a lot of firms that really want to, or are in the process of, or would really like to be able to introduce new products and services that, that really are client facing, and in particular to consumers and households. But that has to be matched with, with an ability to streamline approval processes, to streamline some of these interim permissions. And so it's not that it was surprising, but the degrees to which there was that need, that to me was surprising. The other thing that I found very interesting was just around the nimbleness. I think, it's kind of, it sounds like it's very easy to say, of course they're nimble, they're digital, and of course they're going to be nimble. But to the way that they have been nimble has really focused on creating, a situation where clients can utilize. And so you are seeing changes to, frankly, how they price themselves. That's been the area that they've been changing, the most, which has been really interesting, because if you think about it, what that signals to me is that there is this, how do we just service clients to the greatest extent? And a big barrier in COVID has been price.
Right. Oh, thank you for that. Philip, we're just about to run out of time shortly, but I do want to get your take on this again gives us a great snapshot of where things have been moving over the past few months as the world has been under lockdown in this pandemic. What do you think the future looks like post-COVID? Take out your crystal ball and enlighten us.
Yeah, thanks, Mahesh. It's always a tricky one to predict the future, but we did seek to understand a little bit from the regulatory community, what they envisage for the next 12 to 18 months if the pandemic continues or returns, keeping in mind that this was conducted in August when we didn't have some of these wonderful vaccines that have been developed, which offer us some hope. So I think one of the key things that we're going to see continue is this prioritization and high profile of fintech within regulators continuing. I do think any of us would think that the increased prominence of fintech digital financial services is about to change or go back to the lower level that it was pre-pandemic. And so I think with respect to the culture and the mindset that regulators have, I think it'll continue to be sort of fintech and digital financial services oriented, and that will be reflected in some of the measures and the initiatives that we see regulators taking forward. We've already seen new developments at this time of crisis with regulators launching COVID-19 specific sandbox cohorts and tweaking and digitalizing their regulatory innovation initiatives to kind of adjust, and as Tanya said from the market side, urgently kind of take forward some of these initiatives. I think that will pose challenges, around regulatory coordination, upskilling on fintech, some of the other things that we mentioned a little bit earlier in the presentation. But through coordination and learning from one another, which is a thing we always see, I think regulators are kind of going to come together, and there's going to be a bright future ahead of us. So thank you.
Thank you, Philip. And what a great way to end off such a fantastic session. Thank you, Tanya. Thank you, Philip. Thank you all for joining. And I would urge you to go to the Cambridge Centre's website for those of you who want to download and read the report in further detail. Wish you all a wonderful weekend and a happy Friday. Thank you.